Okay, we're going to talk about bonds today. This is a U.S. federal savings bond. One of my students made it for me years ago, and yes, there's kind of an error, but anyways, I really like the face. Alright, so right here it says $1,000 is the face value of the bond. However, that is not the price. So bond prices is what you want to pay for it up front. Okay, so bond price, say this $1,000 savings bond is $500. And that's the price today. What you want to do is earn interest on this bond. So bonds have risk, though. They have risk and reward. So say you have what's called a AA bond at 10% for 10 years. It's a little bit more risky, but it'll be cheaper and it will pay you higher interest. So you have a AAA bond, which is a much more secure bond like the United States savings bond. The price is going to be higher at $950, but the interest would be lower. So this interest rate relationship is going to be inverse. So bond prices have an inverse relationship to interest rates. So as the price goes up, the risk and reward would move in the same direction. So if you pay a higher price, you're buying something that's a nicer bond, like a AAA bond that's more likely to pay you back. So as the price goes up, the interest rate would go down. And if the interest rates are going down, then that means that more people are going to be looking for something a little less risky. Okay? So say you have the price of a bond that goes down, so it's a cheaper bond, it's going to have higher risk. Okay? But higher risk means I want to get some more reward out of it. So this is a more secure bond. This is a less secure bond. In real life, we have EE bonds that are issued by the federal government, and you can buy those, and say you pay $500 for it, in 20 years it'll turn into $1,000. So it's a good long-term investment. There's some penalties for taking it out early and things like that. So when you get to your monetary policy page, this part right here is going to have bond price, and depending on what happens, if you're doing something that's going to cause inflation or deflation, you're going to have to adjust the interest rate based on how the money supply changes. So as the money supply changes, that will affect the interest rate, and then you can just do the reverse right here with the bond price. So whatever we do to do an expansionary policy, we're going to end up having the money supply increase, which will make interest rates drop, and if interest rates are low, then bond prices will be increasing.